The road not taken. Unlimited quantitative easing, QE. The lockdown in New York State on March 18 signaled a tangible onset of economic paralysis, accompanied by widespread consumer hoarding and significant market downturns. By March 23, the Dow Jones and S&P 500 indices had plummeted by over 34% and 3.9% from their February peaks, respectively. In response, the Federal Reserve announced an unprecedented measure of limitless quantitative easing on March 23, committing to unlimited purchases of government bonds and mortgage-backed securities until economic conditions normalize. This marked a significant departure from previous rounds of quantitative easing, which had defined scales and timelines. This measure aimed to infuse liquidity into the market, stabilize it, and indirectly support bold fiscal policies by ensuring the government could finance a large-scale economic stimulus package without significantly impacting market interest rates. The move underscored the Fed's commitment to mitigating economic downturns and stabilizing financial markets amidst the severe impacts of the COVID-19 crisis. From lender of last resort to buyer of last resort, the Federal Reserve's role evolved from being a traditional lender of last resort to a buyer of last resort amid the COVID-19 crisis. Due to a lack of mutual trust and willingness to lend in the financial market, the Fed initiated direct purchasing of corporate and consumer bonds, marking a significant departure from its usual practices. It launched several emergency lending programs, including the Primary Market Corporate Credit Facility and the Secondary Market Corporate Credit Facility, to directly purchase investment-grade corporate bonds and ETFs. Additionally, the Asset-Backed Securities Loan Facility was reintroduced to support consumer and small business loans. The Fed also announced the Main Street Business Lending Program to assist small and medium-sized businesses, committing to substantial financial backing for these entities. To further stabilize the financial market and support various sectors, the scope of eligible assets for the Money Market Mutual Fund Liquidity Support Facility and the Commercial Paper Purchasing Facility was expanded. Furthermore, the Federal Reserve, in coordination with the U.S. Treasury, introduced the FEMA program to provide dollar liquidity to central banks worldwide, addressing the severe dollar credit crunch and preventing potential devaluation of U.S. Treasury bonds. These measures signify the Fed's extensive efforts to ensure liquidity and stabilize the financial markets during a period of unprecedented economic challenge. Prioritizing stability. The Federal Reserve's response to the COVID-19 crisis has been a prioritized approach to maintain stability in the financial system. Initially, as investors moved from riskier to safer assets, the Fed cut base interest rates to encourage investment. However, as market liquidity dwindled with the selling of even traditionally safe assets, the Fed injected liquidity through open market operations and repo purchases. To address the resultant credit crunch and prevent bank runs, the Fed implemented a quantitative easing policy, which included indefinite government bond purchases and reductions in the rediscount rate and reserve ratio, enhancing banks' liquidity and lending capacity. To ensure stability in everyday financial transactions, the Fed established facilities like the Asset-Backed Securities Loan Facility, Commercial Paper Funding Facility, and Money Market Mutual Fund Liquidity Facility. Additionally, to stimulate the corporate bond market and mitigate lenders' fears of repayment defaults, the Fed introduced the Primary Market Corporate Credit Facility and the Secondary Market Corporate Credit Facility for direct bond purchases. To address the global dollar shortage and its implications on U.S. Treasury bond prices, the Fed expanded currency swap lines and implemented the Government Bond Collateralized Dollar Supply Program. These actions aim to supply dollars to overseas central banks, alleviating international financial strains and contributing to global financial stability. This comprehensive strategy by the Fed reflects its commitment to ensuring liquidity, maintaining banking operations, and stabilizing both domestic and global financial markets amidst the pandemic's challenges. CARES Act, helicopter money. The Federal Reserve's transition from lender to buyer of last resort marks a significant shift in its approach to stabilizing the financial markets amidst the COVID-19 crisis. The Fed implemented several emergency lending programs and initiatives aimed at supporting businesses, households, and the broader economy. The CARES Act, a $2.2 trillion stimulus package, was a pivotal fiscal policy that infused direct cash into households and significantly bolstered unemployment benefits, reflecting a strategy akin to helicopter money. The package also included substantial business support, notably through the Paycheck Protection Program, which provided forgivable loans to small businesses to maintain their workforce during the pandemic. Additionally, the Federal Reserve's role expanded to purchasing corporate and consumer bonds directly, a move unprecedented even during the 2008 financial crisis. This strategy involved setting up special-purpose vehicles funded by the Treasury to absorb any potential losses, ensuring the stability of the U.S. dollar and maintaining economic and financial stability. These measures highlight the Fed's commitment to stabilizing the financial markets and providing liquidity and support during a period of unprecedented economic challenge.